Assalamualaikum warahmatullahi wabarakatuh. My name is Abdul Hanan bin NORDIN, meeting number 1180728. Our group will present about the case study analysis, management of foreign exchange exposure in Tata Consultancy Services Limited. For the introduction, change in foreign currency exchange rates have a considerable influence on the value of investment. Investors should understand the impact of the foreign exchange market on the assets they possess as well as their level of currency exposure. Exchange rates have an influence on investors all around the world. Foreign exchange rates for firms undertaking worldwide business are common as a result of unforeseen fluctuations in exchange rates. A foreign exchange exposure is generally described as a contractual, forecasted, or contingent cash flow whose quantity is uncertain at the time and is dependent on the future foreign exchange rates. Firms commonly use a hedging approach to protect themselves from foreign exchange exposure. The objective of this presentation is focused on to a discussion of Tata Consultancy Service Limited management of foreign exchange rates. Tata Consultancy Services is a global Indian information technology service and consulting firm based in Mumbai, Maharashtra, with its main campus in Chennai, Tamil Nadu, India. Tata Consultancy Service is the world's largest IT service firm by market value as of February 2021. This presentation attempts to give a viewpoint on managing the risk that firms encounter because of changing currency rates, as well as its advantages and its disadvantages.
Assalamualaikum, my name is Muhammad bin HAMIDON 1180723, and for my part I will explain about the foreign exchange exposure in a simple definition, as well as the three types of exposure, and then continue with the exposure management by Tata Consulting Services Limited. So what is foreign exchange exposure? This exposure can be defined as a contracted, projected or contingent cash flow whose extent is not certain at the moment and depends on the foreign exchange rates in the future. There are three types of exposure. The first one is transaction exposure, which referring to a measure of the change in the value of outstanding financial obligations that were incurred before an exchange rate change and will be settled after the rate changes. The second one is translation exposure, which is the risk of loss suffered when stock, revenue, assets or liabilities denominated in foreign currency changes with the movement of the foreign exchange rates. This usually happens when preparing consolidated accounts in home currency. And the last one is economic exposure. This exposure, also called as operating exposure, can be defined as a risk that a firm's revenue would be harmed as a result of a significant shift in the exchange rate and inflation rate. Next is the forex exposure management of Tata Consulting Service Limited. Tata Consulting Service Limited is one of the world's top information technology service providers, which consists of over 353,000 employees and a global delivery footprint that covers over 145 solution centers around the world. 90% of what company earns are from foreign country, and to be exact, majority of revenue is dominated in foreign currency, primarily in USD, Euro, Pound Sterling and many more. In order to manage those exposures, TCS has applied few hedging techniques, which is option contract that mostly used by TCS, believing that this strategy will help their company to retain the benefit of favorable movements in prices of the underlying currency, while at the same time avoiding risk, followed by forward contract, futures and matching. Besides that, Tata Consulting Services Limited also has adopted a well-defined policy for management of foreign exchange exposures. This policy includes the role of the Risk Management Board as well as the accounting standard that will be used as main guideline. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Abdul bin Hamid. My metric number is 1180727. Okay, I will go to the methods to manage the risk. First, we have transaction exposure. We can use risk shifting. It is to prevent transaction exposure by invoicing all the elements of the transactions in the native currency. Next, re-invoicing centers. And the last one, currency risk sharing. The transaction risk might be shared between the two parties. One side might suffer losses and the other side might earn percent. For the economic exposure, we can diversify production facilities and sales to a variety of markets rather than focusing on just one or two. It can reduce the risk. Next, back-to-back loans. And the last one, diversifying financing. to raise financing in the market at the lowest cost of capital. Okay, for the translation exposure, we can purchasing currency swaps and we can use hedging through futures contract. Okay, next we go to the hedging alternative. First, we have forward contract. Forward is a contract between two parties, a buyer and a seller, to buy or sell a currency at a predetermined rate on a future date. Second, futures. A futures contract is more liquid because it is traded on a regulated exchange. However, unlike a forward, which is a custom-made contract, futures are a standardized contract. Next, we have options, swaps, matching, money market hedge, and invoicing in currency. Fourth, we have leading and lagging. To lead is to pay or receive something ahead of schedule, whereas to lag implies paying or receiving something late. And the last one, we have intercompany netting. Netting can be done between inflows and outflows of various currencies, resulting from cross-border transactions between the group's different businesses. Okay, that's all from me. Thank you.
Let's take a look at the advantages and disadvantages of foreign exchange exposure management. So, the firms that have foreign investments and practice hedging techniques are protecting their future from financial conflicts. So, for the advantages for firms that apply any form of hedging techniques, the first one is they have better investment opportunities and higher growth potential. It also shows that the company has made efficient use of the assets under its management, which resulting in improved financial performance. It is also can be said that hedging techniques will save money on a variety of costs associated with extremely variable cash flows. Second, we can see on the option contract. Option contract can be said it is a contractual parties where the right to buy or sell a specific currency is given at a set price within a specified time frame. And one of the advantages of employing option contracts is that they can be used to protect against foreign exchange rate risk associated with products import and exports. It also can be used to protect against exchange rate swings caused by overseas investment in any currency, and it has a high degree of gearing or leverage, making it more appealing for speculative purposes. Third, the two broadly used cross-currency swaps are the cross-currency coupon swap and the cross-currency basis swaps. The advantages of cross-currency coupon swap, for the cross-currency coupon is that it allows firms to manage their foreign exchange rate and interest rate risk as they wish, but the firm that buys this instrument is vulnerable to both currency and interest rate risk. The fourth, when it comes to exchange-traded hedging instruments, the two main instruments are currency futures and currency options. So the main advantage of using currency futures for currency risk, it is that the firm does not need to engage funds equal to position exposed to the currency risk, and it is necessary only to pay initial margin defined as a percentage of underlying contract value. So let's take a look on the disadvantages. So the most common type of option structure is the plain vanilla call, which is defined as buying an upside strike in an exchange rate with no obligation to exercise. However, its cost is higher than the other sophisticated options structures such as call spreads. And besides that, cross-currency basis swap is defined as buying a currency swap, and at the same time paying floating interest rate in a currency and receive floating in another currency. However, it can be pointed out that the major disadvantages is that the primary risk for the firm is interest rate risk rather than the currency risk. And currency futures, on the other hand, are exchange-traded contracts specifying a standard volume of a particular currency to be exchanged on a specific settlement date. And it could be said that the main disadvantage of the currency futures is that they are standardized, which leads to only partial protection from currency risk. Lastly, currency forwards. Using the currency forwards, it has one disadvantages, which is the high cost of forward contracts and the risk of the exchange rate moving in the opposite direction are the serious disadvantages that the firm must consider. So that's all for this part.
From this presentation, we can conclude the effectiveness of forex derivative in managing foreign exchange exposure. Tata Consultancy Service employs forex exchange option on a big scale to manage risk, because the firm earns most of its income in foreign currencies. Option contracts are regarded advantageous to the corporation in terms of giving maximum profit while avoiding forex risk at a lower cost when exchange rates are aggressive. Despite the fact that Tata Consultancy Service depends significantly on option contracts, the firm nevertheless faced significant foreign exchange loss. Tata Consultancy Service, on the other hand, has learned two important lessons in the past. In 2009, their currency rate forecasts were incorrect, resulting in a loss cost of rupees to the corporation. As a result, the maximum maturity profile of forex derivative was reduced from 2 years to 1 year. The shorter time is more appropriate for the company's nature global revenue. The company also employs a range of forward options. If somehow the rate of exchange exceeds a limit, the corresponding loss is increased by the number of range forward options available. Therefore, in contrast to an ideal combination of foreign exchange derivative markets in a firm's foreign exchange risk management strategy, the accurate forecast of foreign exchange rate plays a critical role in successfully controlling a firm's exposure to foreign exchange. That's all from us. Thank you.